Good evening, ladies and gentlemen. My name is Rajat Handa, and on behalf of HSBC Mutual Fund, I welcome you all to yet another very interesting and intriguing session with the HSBC Mutual Fund investment team. I think we've been doing this now for many months and many quarters, and the kind of feedback which we have got from our partners, from our distributors across the country, has been very encouraging. We've got feedback from you. We've got suggestions from you on which topic should we touch upon in the next session, and this is extremely encouraging for us as well as our investment team members who want to keep you updated and keep you informed about whatever is happening within the fund house as well as whatever is happening in the markets. So today's session is one more step in that direction, in that endeavor that we started a couple of years back. Another very interesting session with a very credible and a reputed member of our investment team. Markets, when it comes to equity markets, they have been as unsuspecting as ever. Equity markets are always ahead of us. We thought that, in the month of February, in the month of March, there was no end to the tunnel. There was no light at the end of the tunnel, and markets were appearing like, the story is over for India. But then, who knew that within a span of a couple of months, markets would climb and they would climb and they would run up in such a fashion that now we are almost as close to the all-time highs last year. And this is remarkable. And I think this is what keeps all of us interested and invested in equity markets. So I don't want to steal my fund manager friends' thunder on this. Yeah, I know you are very excited to know about what lies ahead, what is our view on many macro developments, micro factors which are evolving in India as well as globally as I speak. So let me cut to the chase and let me introduce our colleague, our speaker for the day. I'll read out his brief bio. Uh, Please welcome Abhishek Gupta. Abhishek Gupta is fund manager, equities at HSBC Mutual Fund. Currently, he manages two key funds for HSBC Mutual Fund. Abhishek has an experience of about more than 20 years in the equity investment area. Abhishek, before he joined HSBC Mutual Fund, was an investment team member at Edelweiss Asset Management, and he was a senior portfolio manager there. Prior to Edelweiss, he was a member of the equity investment team at Goldman Sachs Asset Manager. From a qualification perspective, Abhishek has done his graduation from Shriram College of Commerce, which all of us know as SRCC, and his post graduation from IIM Calcutta. He's also a CFA USA charter holder. So, welcome, Abhishek. Very happy to have you on this call to share your views on the markets. Ladies and gentlemen, before we start asking questions to Abhishek, I have two requests, one of you and one of Abhishek. The request from all of you is that this is a webinar. We have tried to keep it interactive, so you can see a Q&A tab just below the screens, just below our windows. Please keep typing in your questions. We have a lot of time today, and I will try my level best with all the experience that I have in conducting webinars to put through most of your questions to Abhishek. So this is my request to you. So please keep typing in your questions in the Q&A tab. Abhishek, my request to you is, before I start asking you some important questions that our partners and distributors have given to us before, before we open it up for their questions, would you just want to give a brief, I would say maybe a 1 minute summary or a complete picture in 1 minute of what has transpired in the markets in the last couple of months?
Thank you. I hope I'm audible, Rajat, and
Yes.
good evening to you and everyone. I think clearly, as you pointed out, these are times which are at some level unprecedented, but then again, it's kind of the statement goes right. History doesn't necessarily repeat itself, but it chimes. So from that angle, I think clearly what we saw, and this is not the first time, I'm sure in during piece of our conversation, we'll touch upon those aspects. But clearly, a general election year tend to have some vagaries when it comes to a consistency of delivery at a center level, at a state level, because a lot of things get diverted towards conducting the general election, which is also supposedly the biggest general election ever conducted in the world every time we conduct a general election, right? So I think with that backdrop, some uncertainty which crept up globally because of inflation concerns, Again, there were this last year, calendar 24, was also a year where you saw probably the highest numbers of elections being conducted across the world. So
Yeah.
uncertainties about the continuity of policy making, inflationary risk. We ourselves were going through our share of kind of vagaries and general election conduct. So a lot of things kind of came together, and that at some level led to some profit taking after pretty strong last 3 4 years in the market. The good point is, as we got into this calendar year, a lot of concerns which started to crop up. I'll not say concerns, but maybe some quick shots and some concerns about the on-ground changes which were visible and which led to some slowdown in the economic activity. They just kind of, the government was pretty fast to react to most of those kind of feedback, and they kind of made a lot of changes, which we'll discuss during course of our discussion. And that is exactly why we have seen such strong recovery, because clearly the policy continuity, the certainty, the focus of the government, all of those which were at some point of time questioned last year has kind of been at some level catered to. Just to start, let me just throw some numbers. So from September peak, which was witnessed last year, till March, markets saw almost a 19% absolute correction. I'm talking about Nifty 500, which is broader market indices or
Yeah,
a barometer. From
that's right.
March till now, almost 85% of that fall, similar to 16%, has already been recovered, right? So clearly, I think the vagaries and uncertainty crept up. People got a little concerned, and with stupendous performance of last few years, we capitalize on it. But clearly, in our understanding, market only precedes what you see in terms of earning momentum. As long businesses are strong, you should stay invested. That's our thesis. But I'll be more than happy to address your specific questions.
Thank you, Abhishek. I know it. I caught you by surprise. This was an on-the-spot question on summarizing whatever has transpired in the last few months, and you explained it very, very nicely. And it's a common saying in the Mumbai weather as well as in markets. When it rains, it pours. Okay, so whether it's market falling or whether it's market recovering, you ought to be taken by surprise. You can't predict the intensity or the frequency by which markets will come down or markets will react. And I think we've seen the brighter side in the last 1 month, which again, I don't think many people expected. So
Hmm.
thank you, Abhishek, for these opening remarks. Let me, bring out some very interesting questions. These questions have been shared by our partners, by some of our investors recently when we announced this webinar with you. So the first question is to do with the global market scenario. And what I want to ask you is that the global market scenario has always played a big role in deciding the direction of Indian markets. So, how have things panned out with respect to tariffs, with respect to macro factors like GDP, the currency movement in India and the dollar? And how do these things impact India right now?
No, no, very valid question, and I think I keep repeating this whenever I have interactions. At some level, yes, our economy is supposedly not so much dependent on the global trade flows because we are predominantly a domestic-oriented economy. But then one has to segregate when it comes to capital markets and the economy. So our economy may be segregated in terms of the exposure to global market, but the capital markets are not. Because frankly, if you look at India, India is the fourth largest capital market in the world. So clearly, any change of sentiment, any change of outlook, or maybe some vagaries which emerges at a global level do have its rub off on India, specifically as a market is concerned. With that background, let me probably share some data with you, and that will be
Yes.
much easier for me to kind of share and kind of elucidate what I'm trying to talk about.
True.
Just
True.
give me a minute and please let me know once you see some of the data
I
points.
will confirm once we are able to see your slides, Abhishek. Yeah, Abhishek, we are able to see your cover slide.
Wonderful. So, as you asked, Rajat, I think clearly a lot of vagaries and uncertainties crept up uh, during the change of the guard which you saw in US. And if I can just take you through some of the slides. So this is exactly what happened, right? I mean, clearly with change in guard in US, Trump coming back, and there were a lot of concerns about how the whole world flow is going to emerge. And what we saw from start of this calendar year till probably end of April, a lot of apprehensions came through because again there were some proposals which were seen as draconic. You also saw some of the very extreme measures were already taken up before the even the 5th of April when the proposal came through for your tariff implementation. So to cut this story, what I'm trying to highlight is that with so much of tariff which were kind of considered, a lot of ambiguity and uncertainty crept in the world. And what that led to is clearly it kind of created a lot of uncertainty at the overall equity market because the trade and the supply balances were getting realigned to the ground realities. With that in the backdrop, if I kind of take you through this interesting data, what happened
Hmm.
is that I think clearly one important thing which one has to be always aware of is that ultimately tariffs, no matter which country imposes, is more often than not is something which is being borne by their own consumers, right? Because I mean, just think about it. The global trade happened because either you're not able to make it competitively in your own country, or frankly, you believe you don't have the technology to make those products in your country. So
That's
with
right.
those two background, I mean, even if you import tariff, what we have seen recently in terms of the magnet exports, right? China putting some bans on the magnet export, and the
Yes.
whole of the world auto industry is kind of clamoring for it. So the same fact remains that if you impose import tariff and you don't have the capacity or the capability to produce those in-house, it will immediately lead to supply shocks and even the inflationary risk in the industry. With that in the backdrop, I think the good data which came through in the month of May after pretty turbulent April is that I think on-ground reality started to take balance. I think US and China are already in discussion to figure out the best way forward. But clearly there was a re-evaluation, recalibration of the stance. So the world economy also, which got little jittery in the month of April and May, is coming back to some amount of sensibility and they're trying to figure out what's the best way forward. With that backdrop, if I have to think about how the world economic outlook has changed, clearly, I
Hmm.
think we have seen some uncertainties creeping up, which has led to global economic outlook being reduced world over.
Yeah.
You
Yeah.
would have seen today's data, which was even the World Bank has released. We have seen that the overall economic outlook has been cut between 30 to 40 bips on what was the prior assessment to where the assessment today stands. Among
Okay.
all these major economies, again, I would like to highlight India stands as probably the one of the strongest economy. Even if you pick up the statement by World Bank or if you look at the data which has been highlighted here, it's pretty
Yeah.
evidently visible that India is going to be one of the fastest economies in the world, which is expected to grow between 6 to 6.5% even this year. And if you look at the next year, again, the projections are suggesting that we'll be going back to our normal run rate of about 6.5%. So I think clearly in the times of uncertainty, the fact that our economy is more domesticated. And again, if you think about our export composition, a great composition of our export is also led by services. So those two kind of pillars give a lot of support to your overall economic outlook. And that is why India is able to fare well when you compare with the other, when even when it comes to projections. Now, with that in the backdrop, you did ask me how the currencies have behaved and where do we stand, right? This is not us, and I'm just trying to show you how volatile the world has been. Look at the data. This is the Economist front page, which came in October 19, 2024,
Hmm.
immediately just 6 months prior, right? It says the dollar is the envy of the world. So clearly, that was the ruling currency of the world, and people thought that the US economy overall is doing so well that it's very difficult to raise question and dislodge the certainty about US dollar supremacy. And cut to April 19, barely 6 months down the line, you see the world is questioning the crisis with the world is evolving and what happens to dollar. So this is what is happening in a time frame of 6 months. So you can very well understand how economies are supposed to react is something which is getting a little uncertain in this environment. Now with that backdrop, where do we stand? Now India has the advantage in terms of first of all our forex reserves. So if you look at our forex reserves today, we are almost at all-time high. This data shows you 676, which was the last month data.
Yeah.
If you take the May
Yeah.
data, we're almost at $696 billion,
Very close to
which gives
700.
us
Yeah.
which gives us almost a 13, 14 months cover of our import basket. Now, if you
Okay.
think about it, RBI has said that India needs to maintain minimum 8 months of import cover basket. We are way above that level, which
Yeah.
again gives a lot of certainty and comfort to our currency. And that is exactly what you would have seen that our INR, which is depreciated by almost 3.5% since the worst of the time which we saw at the start of the year. So I think the nutshell, what I want to tell you is that the global uncertainty crept in. The good point is whether you talk about European Union discussion with US, India's discussion with US, China's discussion with US, I think world is coming to a conclusion that all the trades have to coexist. So they're trying to find a way out. And in this context, given India's own strength of domesticated economy and our overall strong reserves, gives us an opportunity to stay above the rest of the people or the rest of the current countries. And that is where even our economic outlook is projected to be.
Yeah, thank you. I think, Abhishek, you answered all the questions, all the sub questions in this big question which I asked you. And very remarkably put, I think those two cover pages from The Economist, what a story. What a story
Yeah,
to share with people. How people turn turtle.
yeah.
I'm reminded of a very important behavioral finance aspect called the halo effect. Yeah, so because dollar has always been king, the positive media and the positive press about the dollar and how things change after that. India, as you rightly said, has shown extreme resilience, extreme strength. We've clawed back from an 87, 88 to a 85, 86 now. And again, things are looking very positive. So you've touched upon a lot of these interesting points in the answer as an answer to this question. The next question is bringing you back to India. Right. So I kind of teased your brains and tickled your brains on global. Now let's come back to India. Abhishek, in your opening remarks, you just started by talking about last year was an election year. Yeah.
Yeah.
People may have forgotten. People have short memories and they move on, and that event will probably come to us again in the next 4 years. But it was a very important year. It was a landmark year, and I think one of the shortfalls or one of the shortcomings of that year was that probably, and this is my understanding, that the government did not spend the way it should have spent because of the
Hmm.
fact that half the year was pre-election and the remaining half was post-election, where government formation, cabinet allocation, and all those things were happening. So last year, if I summarize the government capex, the lack or the kind of government capex that should have happened, I think that was a concerning factor. Now,
Hmm.
coming to 2025, has the situation changed now? And if you can also give us some details and maybe slice and dice the government capex data.
No, no, fairly put across, Rajat, and again, there's no exception to it. But then again, I'm just kind of jogging my memory back and thinking about this is not the first time, right? Whenever general elections
Hmm.
happen, as I enumerated earlier, also, you do see the whole economy or the machinery which would have otherwise been working towards taking care of normal routine activity got diverted towards conducting the general elections. Invariably, a few of the policy decision making are put on a pause because clearly one wants to see what government formation happens and accordingly push them forward. And that is in what leads to some amount of slowdown. So maybe
Yeah.
just first a recapping where we were. So you were right. If you look at the data on the left hand side, the first half of last fiscal, which is FY25,
Hmm.
there was actually a 15% degrowth on the capex intensity. So clearly, we did see slowdown coming in, and it is not an exception because, again, if you look at the right side of the data, which has been shown here, what we have
Yeah.
tried to compare and contrast is what happened in the general election, which was prior to this one, which was in 2019-20, and what has
Yeah.
happened to this general election, which has just played out last year. So
Yeah.
you can very well see in the month when the elections are conducted, there is a sharp decline in the overall capex intensity of the government. But then again, it also picks up equally at a similar pace, and eventually you get the full year number, which are again on the expected lines. What I
Yeah.
would say is that if you look at what year went by, which is last fiscal FY25, clearly I think it took a while for the government because again you have to kind of again kind of be mindful of the fact that this was at some level a coalition government. You need to understand how to realign the whole portfolio of cabinet. You need to
Hmm.
again take into account
Yeah.
what are your allies are expecting from you. So it did take them some time. And in the process, when they realigned and they realized what needs to be done, then the second part of the fiscal, which is October till February, and even as the March data is out now, was very,
Yeah.
very strong to
Okay.
an extent that the government had revised the outlook of capex down from about 11 trillion to 10.2, but you would be positively surprised to know that we ended up actually spending 10.5. So the
Okay.
government revised it down, but eventually ended up outshooting those numbers. So clearly, I
I see.
think the capex intensity went down, which is normal course for power, but they
Yeah.
ended up catching up on those aspects. So that's what the capex number. If I quickly move on, so there is some amount of concerns then that maybe the center is spending, but the state is not spending. And
Hmm.
if you look at the data again on the right hand side, which is at some level true, because if you look at state capex intensity to its overall state GDP, has been
Okay.
on average hovering at about 2.5, 2.6%.
Mm-hmm.
Last year's number was actually 2.5. So people could ask you that then clearly there was a slowdown which you have seen as a percentage of spend of the overall gross state GDP number. But what they tend to miss out, and this is exactly a very important point to highlight, that ultimately as a state, I only have given resources. I
Yeah.
either spend that money towards capex intensity or again I create some kind of consumption basket out of that. Now, this is exactly where, if you see what has happened in last 7, 8 states, where they've realized that they also need to give some money in the hands of the people who are at the lower end of economic status, because clearly you saw inflationary pressure kicking in. And the good part of the story is that almost 0.5, 0.6% of states' resources were actually put in those kind of doleouts, which actually help for the sustenance of the poorest of the poor. So
Sure.
the good part is this government, instead of just being dogmatic about looking at the capex intensity, realized that there is a need for even wide basing the resource availability at
Yes.
the lower end of the strata. They made resources available. The center took the onus of spending money what they committed, and that
Yeah.
is how exactly the overall spending basket was looked into.
Okay. I think that's a interesting economic perspective on how the government is spending capex and how, like they say, every rupee is reaching the grassroots. But this is very remarkable. It's very significant the fact that the government was minus 15% in the first half of the financial year, and then look at the kind of recovery that they have done in the second half. So I think, and if I'm not wrong, Abhishek, I think this momentum will only go up in 2026 and 2027.
Clearly,
Yeah,
so just to add to that, I think again, if you go by this fiscal year budget, the
yeah,
expectation is we will end up spending about 11.2 lakh trillion INR on the capex side. The very
right.
fact that we have spent 10.5 trillion this year, I will actually be surprised if we don't see again an outperformance next year, just like how we saw this year. So I'm
Correct.
pretty hopeful and looking at again the intensity of the spends which are coming through. Again, just to put a very
Absolutely.
interesting number, right? The whole of last year's spend was 10.5 lakh. Do you see March single month? We spent 2.5 trillion of that, which is
Wow.
more than 22%. So
22% of the
22% of
annual
annual capex spend was just
one month.
happened in 1 month of March. So
Yeah.
clearly, when the government has the intensity and the intent, you will see the purses being opened up.
Yes. Perfect. Perfect. And that's a very confidence building statistic and a measure. Let's move on from capex to the other C, which is contributing to almost 65% of India's GDP, economy, whatever you want to call it. And that C, Abhishek, is consumption, right? Consumption is what drives this economy. Consumption is what drives flows into the market. Consumption is what drives capex. Everything is linked to directly or indirectly to consumption. Now, uh, it's larger than life, and which is why I want to spend a few minutes here with you. So consumption undoubtedly is one of the most important levers of our economy, and I'm talking about domestic consumption here.
Mhm.
We've seen this kind of wobble a little in the past. We've seen, domestic consumption wobbling, domestic consumption, probably some sectors declaring, lower demand. Do you see a revival with all the stimulus, all the announcements, all the tax cuts, and the liquidity which is flowing in both from the RBI as well as from the government? Do you see some kind of a final revival in consumption? Very important for us to know that.
No, no, very important question. And to be fair, I think this is where again I give credit to this government that in the if you just kind of think through it, right? They've spent about 11 years being in the at the helm at the center now since 2014. I think initially the whole impetus was to create supply capacities which will bring us in terms of self-reliance, Atmanirbhar, and then we saw PLI scheme. But at some point of time, they did realize, as you highlighted yourself, that for us still 60% plus economy is consumption dependent. So yes, you need to create opportunities, the job opportunity, the industrialization revolution, which needs at a country level, but you cannot ignore 60% of the economy. And that is exactly where what we saw this year. And let me take you through those data points. A very interesting data point. As you said, the first part itself, we all know the current tax proposal has almost led to your tax liability being zero as long as you earn 12 lakh or lower as an
That's
individual.
right.
Right?
That's right.
That's a pretty strong saving of almost a lakh rupee per individual versus what you
Yes.
were paying earlier. If you look at the overall economic impact of that, we are possibly talking about more than a lakh crore of
Hmm.
incremental money, which would have otherwise gone to government, has now been left in the hands of the consumer. So that's one aspect which is very, very positive. Second, and this data goes completely, I think, under the radar, not many people focus on it. If you just think about this whole financial inclusion aspect, with the government
Yeah.
focusing on opening the Jan Dhan accounts, a lot of these direct benefit transfer to the ultimate beneficiary, right? That has completely eased off the whole what would you say the process at which the money flows in. This has led to availability of money at the discretion of the buyer to spend where
Okay.
they want to rather than being forced to spend in a specific basket.
Sure.
That
Sure.
itself has led to a lot of money in the end of the buyer, and the consumptions are very different to what you saw earlier. And over and above that, this is where I think I'm very, very positive upon. So we have already talked about the dole-outs, which has been given by state at a state level. We have already talked about the tax benefit which will accrue to
Yes.
the country at large. And this is another important aspect which will start to kick in, which is the eighth pay commission, which is supposed to get implemented sometime next calendar year.
Hmm.
Now, to again put some numbers, on average, about 25 lakh crores is the wage bill which has been footed by state, center, and the central PSCs. If you go
Hmm.
by the precedents of last 4 or 5 pay commission revision, the numbers have ranged between 15-20% or lower end to almost as high as 40% pay commission revision of the overall basket. If you put those number into aspect and just consider the base case number of 15-20% incremental pay commission revision, which typically happens at the lower end, we are still looking at about a 4 to 4.5 lakh crores of money to be again available in the hands of the consumer. Put all
Yeah.
these three things together. So, as I said, 1 lakh crore relief of the income tax, another 2 lakh crore number which we saw, the dole outs, and another 4.5 lakh crores of benefit which are going to come through the pay hike minimum. It could be even higher. At economy level, just understand the magnitude of the impact. 7.5 lakh crores of money would be available in the hands of the consumer. That's not a small number. That's 2% of GDP, right? Obviously, it will come in a staggered fashion, not together. But that kind of money, when it's available, that kind of clearly create the own
Hmm.
consumption demand. Because yes, incrementally money can get diverted either towards consumption or towards savings. But either way, it's making the households richer. It has got a wealth effect, and that is where we are very, very confident that the whole effort which has been directed by the government to take care of that 60% of the economy. Again, a very interesting stat which I want to bring to your notice, and maybe that also at some level push government to consider consumption boost also, right? As you mentioned, historically, India has seen almost 63-65% maximum contribution of private final consumption expenditure. But even if you look at the last 15-year number, we have been hovering at about 58-59%. If you look at last year's number, right, that was only 56%. So the government realized that the
Correct.
intensity of the capex consumption intensity is going down. They need to give a
Correct.
boost to that, and that's why it has happened. So we are very, very confident that consumption with these benefits can see very, very strong recovery in the forthcoming quarters and years in front of us.
Excellent, excellent. I think this number which you've shown, which is still on the screen, 7.5 lakh crores of money coming in to into the pockets and wallets of Indian consumers. And Abhishek, as you rightly said, financial savings is also financial consumption. It is also linked.
Right.
It's a vicious self-fulfilling prophecy. You earn more, you save more, you invest more, and then ultimately again you spend more because you book profits. And so I think it's very good. It's a very virtuous cycle. And I'm sure that this number is not what this number used to look like probably 2 or 3 years back. I don't have a sense of what this 7.5 lakh crores would have looked like 3 years or 4 years back. I'm sure it's a much, much bigger number this year, thanks to the three important pillars of contribution, which you have shown on the screen. Okay.
Yeah.
Uh, let's move on to policy. Yeah. And who can forget the last Friday? We call it Friday Fury. I think all of us, whether it's friends like you sitting in the investment room or people like me who were glued to the monitor in the mutual fund office, I think all of us were pleasantly surprised. I'm saying pleasantly with block letters, right? Who would have expected a double bonus from the RBI with a 50 basis point repo rate cut and a 1% CRR cut, all packaged together in a beautiful deal? And Abhishek, I'm sure you're going to say this is also going to increase this 7.5 lakh crore of consumption because it's more money which people will be saving. So, with this bumper announcement from the RBI, which is as early as last week, what's your view on two important and probably I would say contrarian factors, opposing factors, right? One, what's your view on inflation? And secondly, what's your view on liquidity?
No, no, very valid question, Rajat, and I think that is exactly where I think I've been kind of highlighting that what I really appreciate is how regulatory is kind of pro feedback, right? You are not considering what has happened in the past as a guideline or a yardstick to define your policies for future. You clearly calibrate the ground realities and you make amends as and when needed. So to your point, clearly, if you think about inflation and you talk about liquidity, two aspects,
Yeah.
uh, you would have heard, and which to its great extent is real, that in India, although the WPI inflation was coming down, the CPI was
Hmm.
the main concern. And it's
That's right.
been more often than highlighted that clearly if it is the food inflation, and to be fair, the monetary policy could not have a direct implication on food-led inflation. It's a supply shock. Supply shock cannot be taken care by the monetary policy. For that, you have to wait for the systematic growth in the supply, and you have to probably wait for the right base to play in, which is exactly what is happening now. So if you look
Correct.
at the current projections of CPI inflation after hovering in more than 5.5, 6.5% level for FY23 and 24 respectively, as we
Hmm.
speak today, the current year projections are 3.8 before, and I think the recent outlook is even lesser at
That's
3.6%.
right.
So
That's right.
clearly, the WI inflation was already tame. The CPI inflation, which is more led by food grain, has kind of again played out to the benefit. And that's also one of the important catalysts which gave RBI that much of buffer to give you the kind of repo cut which we have seen, right? And I'm sorry, if you look at the right side of the data, this was again our expectation before the Friday, which we call it the Friday bazooka. But at some level, it has played out to our expectation because what we saw earlier were two rate cuts of 50 bips. We at a house level were kind of assuming it to be more like 100 bips plus kind of plus minus 25 bips variation. If you look at this 50 bips cut, we have now seen cumulative 100 bips of cut.
That's right.
The good part is RBI has even changed the stance from being accommodative to be more realistic now in
Hmm.
terms of how things are going to shape up in future.
Yes. Yes.
So I think what RBI has done is they have given you front-ended rate cut. They want the benefit of that to translate into the economy. The fact that now we have come to a 5.5% repo rate, which is again, I
Hmm.
think a pretty fine repo rate when it comes to the cost of fund in the economy. They will
Yes.
like to see translation benefit coming into the system. And that is exactly where another concern which was raised to RBI, and which you alluded to, is the liquidity concern which was faced last year, right? To that also, again, to the credit of RBI, what they've done for the first time we have seen, they have clearly set the upper and the lower limit of how much
Hmm.
liquidity they will let in the system. Think about it. Liquidity is
That's
the
one.
fuel which is needed for an economy to keep prospering and keep growing. The very fact that last year, if you look at the calendar of 24, we saw the overall loan growth at system-wide level coming down from almost 16% to a year prior to just 10-11%. That kind of a lower growth was just not only because there was not enough want in the system, but also because the liquidity constraints were imposed in the system. So then, if you are not able to raise enough deposits in the system, you cannot lend further. With that in the backdrop, I think now RBI has very clearly called out that they want to maintain the durable liquidity and the banking system liquidity at plus to minus 1% range,
Yeah.
which clearly again gives a lot of visibility to the banking system at overall level, how they can plan their overall availability of fund and liquidity. To top it, as you have said, 100 bips of CRR cut. Now, clearly, that money which was now lying in the coffers of the government is available for to be kind of lent into the system.
Then to the
And if
public.
you
Yes.
typically, yes, exactly right. And if you think about it, there's typically 8, 10x leverage which is used on the liquidity availability, then clearly that much incremental liquidity could be made available in the system. So if you kind of just sum total the CRR cut which has come into play and the overall cut in the interest rate,
Hmm.
we
Totally.
believe the supply side risk, which was the deposit raise availability and the availability of liquidity, has been taken care of. Now the government impetus is to make sure that the demands are fulfilled, and that is
Yeah.
exactly where we are very, very confident for the banking as a system to go back to the time kind of teens growth what we have seen at the overall loan growth levels.
Absolutely. And bank credit is extremely essential to spur consumption and to keep this
Yeah,
juggernaut moving. So both the things I think answered very well, Abhishek, with a lot of accurate data and strong statistics. One is the reiteration that inflation numbers will stay low, will in the foreseeable future, and they will remain subdued, much below RBI's comfort level. And the second part is on liquidity, which you said that, with these ranges of plus 1%, minus 1% of the net deposit and term liabilities, I think now we are flush with liquidity. And with the CRR cut, the situation is even more improved. So the
yeah,
stress on the banking system, which probably people were perceiving a couple of quarters ago, is no longer there. Thank
yeah,
you for this. Very important from a sentiment perspective, from a financial perspective. Moving on, and it's a related question. Now you've answered about liquidity domestically. Let's talk about the foreign liquidity. Let's talk about inflows coming into the stock markets from foreigners as well as the domestic institution investors. I mean, now, DIIs probably own more than the foreign investors. It's a welcome change. So, Abhishek, my question to you is on flows. My question is that, this has not been a good saga for us since September. So September last year onwards, we've seen consecutive months, probably barring one exception, which was, if I'm not wrong, November or December, we saw large outflows, from India, both from the equity market as well as the fixed income market. It was putting pressure on the currency as well, on our forex reserves. Equity markets obviously were a first derivative impact because of these outflows. Now, I kind of saw a green number in the month of May. I want you to reinforce that. Has the trend reversed? Do you actually see and anticipate a revival of foreign flows in India, or is it too early to kind of uncork the bubbly?
No, so clearly, I think it's a very important, or let me put it this way, it used to
Hmm.
be very important factor. But clearly,
Yeah.
if you think about how the flows have played out in last, and I was very interestingly looking at data which was both last 2 years and last 4 years. First, let's
Okay.
just talk about, as you said, the FIs have not been supporting Indian market. Where do we stand on that background? So clearly,
Yeah.
if you look at the left side of the data, it basically shows how many global emerging market funds had an overweight stance in India. So
Hmm.
from an average, if you look at last 10, 15, 12 years, we have seen about almost 4 or 5 out of 10 funds used to maintain overweight stance in India. Looking at how it has played out in last 4 years post-COVID, now it's barely about one and a half, one out of 10 are putting a active stance in India. So clearly, I think there has been reapportion of India's active weight or the overweight, which has been done by the global emerging market. We can obviously touch upon the aspects about that, but just to kind of reconcile this data, how the active positioning has changed, because clearly as a active fund manager, what I do, what I look at as an emerging market portfolio manager is how do I allocate my resources across countries. Now, India was always a preferred bet. If you think about period starting from June 13th, where at some point of time India was almost 6% overweight, to a point of time where we were almost to come to where we have now, where India is actually 2% underweight when it comes
Yeah.
to an active fund manager at a global scale. So clearly, your point is well taken that if you look at the flows globally, they were a little contrived. I think there were two factors around that. One, clearly, I think the valuations comfort which were emerging in the other part of the emerging markets beyond India kind of made them to reallocate a bit of resources out of India. But more importantly, beyond that, I think there was also a very clear move from away from emerging market to developed market whenever the inflationary pressure hits you. So I
Yeah.
think those two aspects had some implication in terms of how the FI positioning changed in India over a period of last 2, 3, 4 years. But again, the good context which I want to take you to highlight, and you at some point of time touch upon it also. In my mind, there's also a very strong correlation in terms of the flows which you get from international investors and to the underlying strength of the economy. So, as you recollect in our earlier discussion, I highlighted that in the first half of last fiscal, there were a lot of uncertainties which crept up because of coalition government, because of again the change of government policy stance, inflationary pressure, change of stance with US, and that led to almost a $25.5 billion of net FI outflow, which was seen in
Yeah.
the second half of fiscal last 20 FY25, right?
That's right.
So huge
That's
amount of money which was going out because again you found some opportunity in the other emerging market, uncertainty, and the developed market flows from emerging. Think about it after the whole tariff environment or the uncertainties around that crept in. As I highlighted again earlier, India is seen more as a domesticated economy. Among all the major emerging markets in the world, India was the only country which saw a net flow from FIs in last 2 months. And if
right.
you correlate that data from a last 3 months perspective, India has actually received a three and a half, $6 billion, $3.6 billion of FI money in the last 2 months itself. So you said it right. We saw net outflows. We have seen some amount of money coming back. Where is it coming from? Clearly, India's valuation at some point of time corrected, which gave them a lot of comfort. And also the fact that our economy is more domestically oriented economy. So any vagaries of world trade could have a mid impact on India as an economy. So those two aspects have clearly led to the FI turning buyers into Indian market. But then the story doesn't end here. The best part of the story starts now. Clearly, FIs, if they're not putting in money, then the question is, then how is India still able to kind of deliver such strong return if you
Yeah.
look at an annualized basis?
That's
So
right.
I think the whole credit go to our domestic investors. If you
Mhm.
look at, and again, I'll put you some very interesting data which was looking across. So if you look at last 22 months, right, broadly about 2 years, the net money which has been put in by domestic institutional investor in the Indian equity market is a magnitude of $108 billion cumulatively. Make a guess how much FIs would have put in. They actually pulled out $5 billion, right? Let me put another cut to this. Let's take a 5 year view, not just not take a 2 year view. In those 5 years, the domestic institutional investors had put $163 billion cumulatively. How much FI would have put in? They actually pulled out
Nothing of
$3 billion
that.
in last 5 years.
Net negative. Yeah.
So, frankly, yes, you are right. At one point of time, the fate of Indian economy was determined by what kind of FI flows we are getting. But
Correct.
India is now learning to have equity as an asset class. We have all been hearing about the SIP numbers, how the mutual flows are coming in, and that clearly led to this self-reliance or self-sufficiency when it comes to valuing our market on our own accord. So clearly, I think whatever FIs were not contributing to a great extent got counterbalanced by the domestic flows. And above that, and that's exactly where we are standing today. So if you look at,
Yeah.
as you even highlighted, this has happened for the first time in history. If I kind of go back all the way to last 25 years,
Come down.
that the domestic ownership now is superseding the FI ownership.
That's
Trust
right.
me with the fact that India still, if you look at the household's ownership of equity, it's barely 5.96% of their overall wealth or the overall net worth. And if you look at this data globally, this ranging anywhere between 10, 12, 15, 18%. In US is almost 22%. I believe this chart is even going to further expand with the domestic ownership going to surpass FI ownership over a pretty strong visible period of time. So I think the emergence of equity as an asset class, the fact that we have seen now businesses growing leaps and bounds, the whole transformation from unorganized to organized sectors, and a lot of factors coming together has led to this tectonic shift which we have seen.
Brilliantly put, Abhishek. And I think these two, the red and the black, summarize the entire picture. Picture speaks more than 1,000 words. You don't even have to read the numbers below. And this is very heartening because this actually tells you that the vulnerability of Indian markets from a foreign inflow outflow perspective is much reduced. We are much more insulated, as you use the right word. We are much more self-sufficient and reliant because both retail as well as institutional investors in India have a very strong and probably a ground rooted view on the Indian economy and Indian markets. They don't suffer from what we call FOMO, right? The fear of missing out, which we see a lot of foreign investors here today, gone tomorrow, then they come back again because they feel that they're missing out on opportunities. So I think this is a good trend to see. So we keep talking about EV. Okay, we keep talking about EV. We talk about the Japanese EV, the Chinese EV. I don't think there is too much to talk about the Indian EV right now, but there is one EV equation which all the portfolio managers and fund managers and people in your league and community are forced to answer. And I'm going to ask you that question regarding that EV. And the EV which I'm talking about is the earnings valuation conundrum. You could not escape this question, Abhishek. So, the two sides of the market coin, earnings and valuation. What's your take on these two important market measures? Also, if you can just briefly tell us, considering both earnings and valuations, what is your sectoral outlook? Which sectors appear a little more attractive and balanced when you look at the EV conundrum?
No, no, I think Rajat, as you highlighted, no discussion on the equity market outlook is over till the time we talk about valuations, right? And to be fair, I think okay, so let me just straight away cut to the chase. And
Yeah.
as I was talking about, let me just take you back to start of this fiscal year, last fiscal year.
Sure.
We got into general election, we got into some slowdown. We have already touched upon those aspects. Clearly, to put the numbers in front of you, we saw almost a 11% cut in the Nifty's earning for FY25 from where we started to where we ended up. Not that we
Mhm.
degrew, we still delivered a 3.4% annualized growth in the Nifty 50. If you look at
Yeah.
the large cap, we grew almost even higher than that at about a 4.5%. You will be surprised to know that if you look at the numbers from a full year basis for small and mid, the growth, and this is pure earning growth, mid
Mm.
cap grew 22% even in the year of FY25. And trust me, when I asked this number with most of my colleagues, no one was aware that this is the kind of growth you've seen in mid cap. Even small cap did fairly okay at about a 7.5% growth. So my context here is that clearly what we started the year with, there was some slowdown factor which came into
Yeah.
play that led to some corrections in the overall outlook on the business side. But what is encouraging is again, if I look at how the downgrade cycle has been going on. So at some
Sure.
point of time when we started the year, we saw pretty strong cuts in the earning momentum for the FY25. But if you look at from a perspective of where do we stand on FY26 now, after whatever corrections have come through. So first of all, the Q4 of FY25 itself was a strong quarter. With almost after 5 quarters, we saw 3% beat to the expectation at large. So the downgrade cycle, in my mind, to great extent got arrested in this last concluded quarterly result season. And
Hmm.
on top of that, there were few factors which were more cyclical in nature, whether we talk about oil and gas, energy, commodity, which had its own impact of compressing your earnings. Now,
Yeah.
given that base is formed now, there is also going to be equal opportunity in terms of expanding
Yeah.
your earning visibility from next year. So it's kind of a
Sure.
spring and a coil. You
Hmm.
suppress the spring, it reduces your visibility, but at the moment you release it,
The
it
recoil.
even expands the number, right? So with that backdrop, if I come back to the valuation, clearly, and in my mind, I always keep reiterating in equity market, if there is only one thing which you have to monitor as an investor, you should only invest on or monitor the underlying earning momentum of your businesses. Now, this is the earning momentum of Nifty 50 at large, which basically is
Yeah.
sum total of the top 50 companies. If you look at, we have seen historically in last 22 years,
Hmm.
almost a 12% earning CAGR.
Okay.
Now, this after FY25, as I said, it's kind of a course correction year where you did not see a very similar kind of earning momentum. But again, where we start today and how we look at for the next 2 to 3 years, we're actually going to do similar or even better when it comes to the earning visibility outlook from a next 2 years perspective. So
Sure.
first of all, 25 was not a change of stance. It was not a structural downgrade year. It was
Hmm.
just after very strong last 3 4 year, it was more of a breather year where the corporates took a breather. They wanted to get clarity in terms of the government policy making. They wanted to understand what's the way forward from a next 5 years perspective. Now, with a lot of those reiteration coming in, I think a lot of those purses would be opened up again from a private capex perspective, consumption perspective, and that should again give momentum to the economy. The very fact that the economic outlook is very similar to what we saw last year or last 3 years gives me confidence that we are again on a path of recovery, which we normally have been doing in last 3 4 years. So with that backdrop of how things are looking, let me just touch upon the valuation as you talk about.
Sure.
So there are three main pockets, right? Large, small, and mid.
That's right.
First of all, large. If you look at last 10 years average, it has been about 21 times. Where we are today is also 21 and a half times. So
Hmm.
large cap, even after giving good, strong performance in last year, because it was backed by a decent earning momentum, has not got any valuation concerns, even if you go by last 10 years average. More
Acha.
importantly, the moment you superimpose the ROE data on that, that actually makes large cap look cheaper. Because clearly, as a businessman, if I'm paying X amount for a business which is generating me 14% or 13.8% return to be precise, the moment that business are generating 15% return, I should be willing to pay more. But in reality, you are exactly paying the old price, even when the business structurally has improved the earning profile of the business. So
Yeah.
that's where we believe on the large cap side, taking your view or taking you towards the mid and the small cap side. I
Yeah.
think again, on absolute basis, the multiples may look higher. If you look at mid cap multiple, it's
Hmm.
about 29 times. If you look at small cap multiple, it's about 26 times. But what I want to you to focus upon is clearly, as I was highlighting earlier, India is in a process where we are evolving from an unorganized to an organized economy, right? So clearly, the businesses which have been on the lower end, from regional to national players, from family owned to professionally run businesses. So clearly, though that evolution, where a lot of businesses are now becoming size, scale, and they're becoming national brands, there is a re-rating which is logical to do, which is going to happen with the passage of time. Now, you
Yeah.
can't clearly value a business which is generating 100 crores of profit at a X multiple, and the same multiple will be used for a business which generates 1,000 crores of profit. So I think this whole, and you have all, as I've already shown you, small and mid caps have actually been delivering faster running growth CAGR, whether you look at last 3 years, 5 years, 10 years data versus the large cap. So clearly they ought to trade at a multiple to what you have seen in the large cap. Now large cap itself trades at about 22 time multiple. So a mid cap multiple of about 29 time and a small cap multiple of about 25, 26 time looks higher than historical number. But the moment, and that is where I keep highlighting that, don't look at PE. That's just one part of the story. Look at PEG. The moment you
Growth.
bring the G part of the story, the growth, this is exactly where you understand what you are paying for what kind of growth for the business.
Yes.
So I think in
Yes.
our understanding, valuations across the board are not expensive. But do I see a multiple re-rating opportunity? Maybe not. So then clearly this market from a next 15, 18 months perspective is a market for an active stock picker. You have
Yeah.
to allocate your resources in the right businesses in the right sectors rather than just playing a structural multiple rating opportunity, which could have played out some point of time, but not something which is visible to us right now. So that's the backdrop on how we look at the valuation. And this is exactly where I'll kind of hold my thoughts at.
Yeah. Are you also talking a little bit about sectors, Abhishek? So, which are the
Yeah.
sectors basis
So
your
clearly on the
view?
sector side, as I've been highlighting, so I think this is the conclusion which we're coming to. So
Hmm.
we believe that whole of last year, as we have been talking about, had a suppressing impact on the earning visibility. The fact that we believe this year's consumption boost can be played at two different levels. One is pure discretionary consumption, is one segment where you see opportunity because clearly more money in the wallet or in the hands of consumer after taking the need for sustenance and stability, you do see some money being spent in terms of the discretionary side of the spend. Along
Yeah.
with that, and this is a historical data, whenever you get these bumper money in your wallet, there is also intensity to save that money. So clearly, I believe financialization of saving as a part of the overall consumption basket, because ultimately, whatever extra money you generate gets either divested for investments or savings or consumption. So these are two baskets with the fact that almost 2% of the GDP is now going to be in the hands of the consumer is something we were positive upon. We believe still with the fact that now private capex intensity, which was kind of held back for the uncertainty or maybe the curiosity of how the policy making forms up, with now those clarity emerging, clearly something we were positive upon. So I think a lot of private led capacity expansion, which could give you opportunity in terms of either the equipment supplier or the contractors, is again another space we were positive upon. I also believe that this slew of rate cut which have come in, that
Hmm.
overall makes the cost of fund environment pretty cheap. And in that
Yeah.
environment, those who are bulk borrowers, whether it's corporate or even NBFC which borrows in bulk, could have an opportunity to borrow more money. Easy liquidity again give them more supply, and then they use their supply and lower cost of fund to again accelerate the overall loan growth in the system. So maybe NBFCs which can have the benefit of this whole rate cut, the consumption, the financialization of saving, the private led capacity investments, capex opportunities is all something which can come together. And from a portfolio positioning perspective, if you think about these are again the sectors we are positive upon, and that's exactly our stance at this moment.
That's very well articulated and very well summarized, Abhishek. I'm sure there are many more sectors that you're very closely monitoring and
Yeah.
watching. But thanks for sharing, your top horses right now and appears very logical. Frankly, the impact of liquidity, rate cuts, consumption picking up, I think all this sounds very logical.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.